On today's Hashi, I'm discussing the minutes from the March FOMC meeting, Redfin's rental market report, weekly unemployment data, and the producer price index. Today is Thursday, April the 11th, 2024. I am Byron Lazine, and the hot sheet starts now. Good morning and welcome into the hot sheet, where we've got a lot to uncover. We have a market, stock market, that is, investor market, which is really uneasy. The news just continues to kind of pile in on where inflation might be headed. We're going to get to that. We've got a new inflation report today, which was better than expected. We like that. But is there other news and information that's countering that? We'll get into all of that here as we dig in. Let's first jump into the FOMC minutes. This is from the last meeting. There are key details. The Fed wants more confidence that inflation is moving towards its 2% target. Okay, this is coming out of the meeting minutes from the last meeting, which we covered in its entirety here on the hot sheet. We covered the press conference. Now we get to see the behind the scenes look. Okay. In this meeting, they were using this language that they're just not confident that we're heading there as of yet. Well, since that meeting to today, their confidence, would we say, is, more or less confident? It's probably less confident, especially based on what did the market do yesterday? I mean, if we think about what the market did, let's just back up here. If we think about what the market did yesterday, off of a CPI that really barely missed, right? Expectations were that, we'd have a CPI year where we had 3.8. It came in at 3.9. It was supposed to be 0.3 in the month. It was 0.4. It matched the month prior. So it's like, wouldn't you look at that and be like, hey, CPI inflation data barely missed yesterday, but the market didn't seem to look at that as a barely missed. The markets, the Wall Street looked at that as, oh boy, we may not get rate cuts. I mean, look at how the 10-year reacted and look at what the 30-year did just yesterday. 7.34 bouncing from 7.06. This is what I keep talking about, bumpy road. That was a minor bump. CPI is not even the number one measurement, as we talked about yesterday at the FOMC. So these little tiny hiccups, if they're even, a little bit bigger of a speed bump, could shoot us right back to 8% on the 30-year fix. That's just as possible as what, Fannie Mae, some of these other have projected, where we could get down to 6 by Q4 on the 30-year fix. We're closer to 8 than we are to 6, by the way. So all of these things are on the table. We can't live as real estate professionals, whether you're investing or advising, can't live in a fairy tale world where we just expect that, okay, yeah, the 30-year fix will come down over time, that it's going to happen sooner than later. Okay, don't trick yourself into waiting around for that. Take action and activity now, regardless of what happens with the market. Sorry. So going back to the Fed meeting minutes, there are inflation concerns, and they're expressing worry that inflation wasn't reducing quickly enough towards their 2% target. Okay. These bullets are all available for you in your BAMX hot sheet show notes. Here are some mentions of housing in the FOMC minutes. You can get this obviously right inside of show notes. On page 7, fourth paragraph, mortgage delinquency rates for conventional and Department of Veteran Affairs loans were largely unchanged in December and January, but delinquency rates on FHA loans picked up slightly. You're going to start to hear about this, especially as we come out of forbearance. We come out of other, we're coming out of all-time low on, delinquency and foreclosures, where it's like we're even below a healthy level, as I've described on past hot sheets. You're going to start hearing people say, oh, well, delinquencies are picking up. That's not going to really impact inventory for 9 to 18 months, even on the ones that do pick up. But I'm not saying that there's going to be a lot or anything like that. I'm just saying on the ones that are available, we know how long that takes. That's a 9 to 18 month run. Page 8. In their outlook for inflation, participants noted they continue to expect that inflation will return to 2% over the medium term. They remained concerned that elevated inflation continued to harm households, especially those least able to meet higher costs of essentials, food, housing, transportation. A few participants remarked that they expected core non-housing services inflation to decline as the labor market continued to move in a better balance and wage growth moderated further. What do they mean by wage growth moderating further? They don't want people to keep making more money. They want it to kind of stabilize. More money means more inflation potentially. Participants discussed the still elevated rate of housing services inflation and commented on the uncertainty regarding when and by how much lower readings for rent growth on new leases would pass through this category of inflation. We saw in the CPI, we're still waiting. We're waiting for these new leases to reflect lowering of housing inflation. We just aren't seeing it, right? And it's a lagging number. We get it because, if you want to reflect what a lease being signed in Tampa today is, you got to really wait 6 to 12 months to get that data. That they're just not getting the way the government's work. They're not getting that new lease data the day it's signed because they use an antiquated system. We're going to look at asking rates, which don't point towards lowering inflation. Unfortunately, we're going to look at that report here in just a minute. Furthermore, on page 8, second paragraph, participants noted mixed reports about the pace of home building and amid self-elevated financing costs for developers, despite strong housing demand and a limited supply of affordable housing. Some participants noted that increased immigration, which had likely been boosting the growth of personal consumption spending, may have also been adding to the demand for housing. Okay. There are parts in the country right now, though, where maybe they overbuilt. Maybe demand just doesn't seem to be there. I hate that word from the Big Short movie that agents are like, there's a lull in demand. Is there, or is it reflective of the national trend that 1 out of 4 mortgage buyers have disappeared? And maybe the COVID surge in your market has dissipated and you're seeing inventory go up. All these factors might play into it a little. Inventory continues to increase. You really start in a market to uncover what demand is truly there. When you have no inventory, it always feels like demand is extremely high. Now we know that there's a locked up, pent up demand, but that's affordability dependent. For those that are sitting on 3%, now the interest rate is up over 7.25%. That might continue to get locked up. We know that as it goes down closer to 6%, we've seen this in the past 24 months. Anytime we get closer to 6% on the 30-year fix, that is, then we see some of that pent-up demand kind of sneak out. It comes back out of hiding a little bit. All right, so those are the highlights on the FOMC minutes. You want more on that? You want to pull data from that? You want to learn a little bit more about how the Fed was thinking at the recent FOMC meeting, which was held March 19th and 20th. Grab all of the notes. We pulled out everything that's important for you inside of your hot sheet show notes available on the BAMX platform, along with, of course, all of the charts each and every single day from this show, including the charts here that we can dive into next. According to Redfin, the rental market tracker that they produce says that asking rents, something that inflation with the government's measurements are not taking into account, asking rents, current asking rents. Redfin says that those actually rose for the third straight month in March. This is being driven by the Midwest in particular. The median U.S. asking rent rose 1% from a year earlier. By comparison, rents jumped 5% in the Midwest, in part because the region hasn't seen as big of construction boom as other parts of the country, right? If we look at the Sunbelt states where you've seen all this multifamily apartment housing come online and more to come, that's where you're seeing a more competitive environment. But here are the U.S. asking rents going up across the U.S. for the third straight month, still off of the peaks that we experienced in 2022 and 2023. We're now at $1,987. The year-over-year change is 0.8 percent. Okay. That year-over-year change trend, though, overall, you do see coming down, even though we've got a bump up here in the third straight month. If we go year-over-year, that trend is coming down. Okay. So, or if we go over the short period of time, rather, of recently, that trend is coming down. So I would still argue overall with the amount of apartment housing coming online, we've cooled way off on accelerating rents. 1% is more flat to me than it is, a trend of takeaway, rental inflation. We're in a much better place. And I'm just not certain that all of the cooling off and the downward trend we've experienced the last 6 to 12 months is even reflective in the data that we're seeing, the CPI, which certainly would impact that inflation number. Okay. The Midwest sees asking rents rise to record high in March. Now the Midwest is, one of the most affordable. It's more affordable than in any of the other regions. If you look, it's a record high for them, but I don't know, the Northeast and the West would laugh at those numbers from the Midwest. No offense to our Midwesterners, but you guys are living good here, under $1,500 median asking rent per month. That's living good. Ask your friends in the Northeast and the West. The West at $2,500 and the Northeast just under $2,500 on the median. The South is over $1,500. The year-over-year change, Midwest has the biggest increase there, of course, because they have the best affordability. Then you got the Northeast, which continues to go up. They don't have as much inventory either, similar to the Midwest. So no surprise, those two are at the top for year-over-year changes, while the South and the West, we've seen more. The West, for example, is down, and the South is basically flat on year-over-year change on asking rent. So, if this is accurate data here from Redfin, I'm not saying that it's not, but if it is accurate data, then that's kind of another small little trip up on potentially getting that housing inflation down to where we believe it should be, and really reducing inflation as a whole. Now, we did have some good news today. It was the Producer Price Index report that was released this morning. The Producer Price Index, PPI, for final demand rose by 0.2% in March, following increases of 0.6% in February and 0.4% in January. This beat expectations. So like yesterday on CPI, which the markets like to look at CPI, the stock markets, Wall Street loves CPI. And we mentioned yesterday, FOMC loves PCE. Nobody really has PPI as their favorite, but this is another data point in inflation that is being looked at by all parties. And the good news is it beat expectations. So while we didn't see that win that we wanted to see yesterday, we did get it here on wholesale prices. I'll go in a little bit deeper on that now. That being said, that we beat those prices, the Dow, the S&P, and the NASDAQ, after getting absolutely crushed yesterday, isn't reacting really to this PPI report at all. It's like, okay, big deal. We don't really care because we're not doing anything. We're still cautious. We're not moving one direction or another. Dow is down a tick. S&P's flat. NASDAQ's essentially flat. I mean, you're seeing a slight rise, I guess, in the S&P as these are being assessed, but certainly not getting the gains back of the significant losses yesterday. And remember, we just missed CPI by a little bit yesterday off of expectation, and you saw how wild of a swing the stock market was. So, that wasn't a bank failing. That wasn't anything more dramatic that could happen. That was just boom, little trip up, and we saw it swings. The 10-year is still up over 4.5. We'll get into that in a little bit. So the 10-year hasn't said, hey, okay, 24 hours later, we've assessed this and we're getting more comfortable. Not the case at all. All right, going back to the PPI on what stands out. The increase in March was primarily driven by a rise in prices for final demand services, while prices for final demand goods decreased slightly by 0.1%. March prices for final demand, less food, energy, trade, increased by 2.8%, reflecting sustained inflationary pressures on the economy. So there you go. I mean, I really think that's the big takeaway. I do have something else I think that's interesting on inflation. I'm not trying to be a Debbie Downer, but this is a headline today. I'm sorry, late yesterday, this headline came out, and I heard this in other places, commentary across the markets. The super core inflation measurement, okay, shows that the Fed may have a real problem on its hand. What do I mean by this? Okay, markets are buzzing about an even more specific price gauge contained within the data. Okay, so we saw, okay, I just told you the number CPI yesterday. We missed it by a little bit. But the super core measurement measures services inflation excluding food, energy, and housing has been roaring higher lately. This is up 4.8% year over year. Remember, CPI was 3.9% year over year when we looked at it yesterday. This super core measurement, just another measurement, another way to look at all this inflation stuff, right? 4.8% year over year in March. Now, when you go 3-month annualized, that's at 8%. I made the comment yesterday, hey, we're not anywhere at 8% inflation. Well, when you go 3-month annualized, because what have we had in the first quarter? We've had hot inflation reports. I said it in January. I said, don't get excited about 5% 30-year fix. You're going to mislead people. Not coming. Bumpy road. Okay. Now, I never thought I'd be sitting here saying, hey, we're back to runaway 8% inflation. I'm not saying that we are. I'm saying that the super core annualized on 3 months, I'm not even saying it, CNBC is, that's 8% on 3-month annualized. So inflation is rearing its ugly head again. Inflation is showing us that, okay, it's very stubborn here. We may have a little bit of a problem. And, unfortunately, the Fed just doesn't have a lot of tools to cover up the mess that really they supported by printing all of that money. The Fed doesn't have a tool to really clean that mess up other than potentially raising rates. Wait a minute, I thought we were promised 3 rate cuts. Well, we were, and this is why you're seeing the markets react so negatively to the news, because now there's just all this uncertainty backs up in the minutes that we just saw of what the Fed's going to do. Don't count on a rate cut really supporting your real estate market here in 2024. Okay, we're at 7 3/8 right now on the 30-year, jumping up over 0.25% just yesterday alone. The bumpy road on the cost of finance is going to continue here, certainly in the short term. I'm hopeful the pressure of November election will get the Fed to start cutting, but I don't want the Fed to cut if it's going to mean a huge recession to follow. If they make a mistake for a short 6-month, gain of people feeling good about the economy, and then it leads to a 2-year recession, don't want that. We got to clean up the inflationary issues. One of the things that we watch when it comes to inflation, of course, is weekly unemployment data. In the week ending April 6th, the advanced figure for seasonally adjusted initial claims was 211,000. That's a decrease of 11,000 from the previous week. So initial claims on unemployment continue to be flat. I mean, this is about as flat as it gets. Seasonally adjusted insured unemployment. We've got low unemployment. There's a lot of reports that folks are working second jobs because of the inflation, taking out more personal debt, working jobs that they don't want. There's a 5% increase in people taking second W-2 jobs. That's what's reported. That doesn't include, 1099 Uber work, these kind of things. So a lot of people are looking for ways to get scrappy and make some more money in this type of environment. Because of that, obviously, unemployment really a low number here, truly. And so people are trying to do what they can to hold up the wall, the dam of inflation that is trying to crack through. Okay, here's where we're at right now on the 10-year Treasury. The 10-year Treasury is just very sticky here. Here's the 1-day look. It's kind of been bouncing up and down, up and over 4.5. We're at 4.5 4.48 right now on the 10-year. We saw yesterday crossed over 4.5, went back under. That movement reflected in a big increase on the 30-year fix, going, of course, from 7.06 to 7.34. So that's the deal there. That's the closeout for the week on the hot sheet. But if you want to increase your ability to be not worried about inflation, not worried about what the market might do, because you've got such a bulletproof brand, I would encourage you that there are some opportunities coming up for you. I've been talking a lot about BAMCamp DC. I'll talk about that again in just a second. But I also want to talk about 1,000 watts event. Okay. You should also sign up to the dose, which just popped up there. It's a great newsletter. But 1,000 Watt Brand and Marketing Summit is happening June 25th and June 27th. So if you can't find us BAMCamp on June the 6th, you should find yourself in Dallas at the Brand and Marketing Summit for 1,000 Watt. What are one of the ways that you can protect yourself against everything? It's having consumers come directly to you and having a bulletproof brand. We said yesterday during that seller generational report, 65% of sellers are picking either the last agent they worked with because there's brand recognition there, they're doing a good job staying in front of them, or they've gotten some type of referral from a friend. Well, those referrals from a friend land on all of your marketing and do a research and analysis before they even get to you. So what is your brand saying about you? There's nobody better than Mark Davison and Brian Boero of 1,000 Watt and the crew that they've put together for this event. It's June 25th through June 27th. We've got a link down below where you can get a discount offer there. I'll put the information down below for 1,000 Watt. Also, we are, I believe we might even be past it. It probably shut off maybe yesterday, maybe it didn't, but early bird pricing on BAMCamp DC, pricing at this point now with where the sales are heading is going to rapidly increase. So if you're thinking about BAMCamp DC on June the 6th, make sure you sign up now to get the lowest price possible. BAMX members, you get 25% off of that. BAMCamp DC, we'll have that link obviously down below as well. June 5th, the day before, there's a mastermind component. So if you want to sign up for the VIP experience, you get VIP seating at the event. You'll get the mastermind where we're going to go over buyer and listing presentations. And you'll get the lowest price possible right now by signing up for that. And then, of course, next Wednesday, BAMFest, free virtual event for BAM. Make sure you attend that. So much good stuff going on there. All right. That's the week for the hot sheet. Tomorrow, we're going to have a new Knowledge Brokers podcast over at the other channel at Knowledge Brokers Podcast. Make sure you head over there on YouTube, Spotify, or Apple. Subscribe and check out that pod as we wrap up the week with myself, Lisa Cinotti, and Tom Toole. Thank you guys very much. Appreciate all of you. Hope everybody has a great rest of your Thursday and a great weekend. Until next time, of course, toodaloo.